All right, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I am going to be walking you through how I am viewing the current markets. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual, tax, legal, or investment planning advice. Our agenda for today, we'll be kicking off as usual with the major equity indices. Big day today as we have a CPI data release. And that's pretty much going to confirm where equities are heading in the near future. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model and see which sectors are outperforming and underperforming the overall market. From there, we'll move on to some subsectors of interest that I have for you today. And we will end today's session with some bullish and bearish market observations. So before we take a look at the interest rates, at the major equity indices and those key levels, I just want to take a quick look here at the probabilities for the next Fed rate hike, which is on the 22nd of March, and currently our target rate is at 450 to 475. We got a 25-point hike a couple of weeks ago. That was largely expected. And that was largely priced in. And for the most part, we are expecting another 25-point hike, which will take the target rate to 475 to 500. Fed futures are pricing in that probability at around 88%. However, compared to last week, this was at around 99%. It was almost a certainty. And now there has been a little bit more ambiguity coming into the equation, with now the probability of a 50-point hike increasing slightly. It's still, heavily implied that there will only be a 25-point hike, but a bit less than it was last week. Now, in my opinion, despite what happens with inflation data, unless we see something absolutely catastrophic, which, I don't think we will. Looking at core CPI just there, it's coming in slightly above expectations, but not by 5.6 compared to 5.5 year on year. CPI 6.4 compared to 6.2. So month on month is in line. I wouldn't say that that's a catastrophic miscalculation. It did come in hotter than expected, and that should technically see some bearish price action in the short term here for equities, but with inflation coming in hotter than expected. But that's not a big, a big miss by any means. So I don't think that the probability of a 50-point hike is going to increase that dramatically. And I could be wrong here, but it doesn't seem to be a huge miss. The one thing that was concerning was the jobs report. So jobs reports in a hot labor market leads to higher inflation. And we had a very, very hot jobs report with the economy adding almost 3 times more jobs than analyst expectations. So that could be one of the reasons why we are seeing the probability for a 50-point hike increasing. But for now, I still think it's going to be a 25-point hike come 22nd of March. All right, so taking a look here at the S&P 500. So what we see here is a bit of a pullback last week, right? We pretty much knew, or we knew there would be a pullback. It was the right time from a technical perspective with price reaching an overbought condition. And since then, there wasn't a lot of bearish momentum there. Yes, it did trickle back somewhat slightly from 420 all the way down to this 21-day exponential moving average at 405. But that's not a lot of bearish price action. And already it's starting to show signs of life, bouncing a little bit higher from there. So this screenshot was taken a little bit before the inflation announcement came out. The inflation announcement did come out at the start of this webinar, and futures are a little bit higher since then, but not by much. So it does look like there'll be a revisit back to this 420 level. And the big level here is really 420, which is a 23.6 fib level, as you can see on the weekly time frame. And it is an area that's provided support in the past, as well as some resistance. And price is on an upward trajectory after forming some capitulation. It's forming now higher lows, found support at the 38.2 fib level, and we could see a breakout above 23.6. And honestly, it's more of a matter of time until we get that breakout anyway. The big question is how far can price head in the next couple of months after it breaks above this 420 level, because we know that in that pandemic run, that bullish market that we had for 2 years before 2022, that was pretty much induced due to the fact that we had very low interest rates. However, now in a higher interest rate environment, it will be quite interesting to see how equities navigate through that. And so far, I think equities have been navigating it through it quite well to start off the year. I don't expect to see the same momentum that we saw during this 2-year rally, because again, higher interest rates are naturally going to act as a headwind. We also have recessionary fears to consider, but the fact that price is already now knocking at the door of this 420 major resistance could indicate that we could be in store for a grind higher, a slow but steady grind higher here for equities. Okay. Moving on to the NASDAQ 100. And similar price action where we have saw price break above a key area of resistance and strong psychological level at 300. Since then, we saw a bit of a pullback all the way back to the previous area of resistance, turning support, and a typical bounce higher with some decent momentum. So this is some bullish price action. We've already had an inflation announcement, so there shouldn't be any other strong fundamental catalysts to get in the way of this rally. And we could see it again a revisit towards that 315, 316 area. And from there, that's a very strong level to look at. And then we also have the swing level over there, just below 340. And we have 360, which would act as another area of resistance, which was a previous area of support and resistance. So those will be the two upside levels here for the NASDAQ 100. And again, a lot more sensitive to any perceived changes in interest rate policy, due to the fact that they are more exposed towards growth and technology names. So IWM, which is a Russell 2000 ETF, so looking at small caps over here. And last week we spoke about the high probability of a reversal at around 200, strong psychological level, heavily overbought. And that is quite significant considering the breakout above 188, which was a very strong resistance area, the 38.2 fib level. And we were looking at price potentially retracing back towards this previous area of resistance, turning support at 188. And that is pretty much what has happened almost to the cent last week. I mean, I would say, yeah, on Friday and even yesterday, we had some bullish price action. So we got a classic breakout, pullback, and retest. So for now, it does look like we may see a continuation of this rally, but again, it's very dependent on how markets open with the inflation data that just came out. Is it only going to be a short-term hit? Is it going to be just bearish price action for a day and then back to normal and back to this continuation of this rally? But when you look at the overall structure of equities across the board, it's definitely on a bullish trend. It's definitely forming higher highs and higher lows, as you can see there. And in the case for IWM, the fact that it broke above a major area of resistance, now turning as support, it does indicate that there could be a continuation higher here. And with the inflation numbers that we got, I don't think it's a disaster, even though it came in a little bit hotter than expected. We may see another retest of 188 before a move higher. But the key thesis here is the fact that price is above 188. It's above the 38.2 fib level. And IWM has traditionally respected its fib levels over the last 2 years. Right, moving on to bonds, looking at the TLT ETF here. And not much to say on this, honestly. Just recapping what I've said over the last few weeks, with 108 acting as a major area of resistance. Longer term price action remains in a bearish structure, and we have the previous swing low before that 92.50 swing low. previous swing low acting as a strong area of resistance. So still forming lower highs, lower lows on the weekly time frame. Daily time frame, though, it is actually forming higher lows. And for me, that indicates that we may not see a revisit to 92.50 anytime soon, now that we know where interest rates are heading, roughly just above 5% or so. We know that TLT will remain somewhat more neutral until we see, or until we hear any news about when the Fed will start to initiate interest rate cuts. Right now, it's looking like November, but it may be a bit longer with the data that we're getting, the fact that inflation is still coming in a little bit above expectations, the fact that we still have a hot labor market, it could push out the Fed's plan to start cutting interest rates. But for now, price action remains bearish to neutral. I'd say more neutral than bearish, with 108 acting as a strong resistance area. Moving on to the US dollar, and interesting price action here because overall structure is bearish. I mean, on the weekly, on the daily, over the last couple of months, and on the daily. There's been a bit of a grind lower here in the last couple of months, but price has found support at 101, and this was a downside target that we were looking at over the last few weeks, really, in the last few months. This area between 100 and 102. But if you look at the price action, when price hit 101, very bullish. Three big candles. Shorter term momentum almost reaching an overbought condition, and price breaking above its 21-day exponential moving average. And this is where the key test really is. Traditionally, this area between 21 and 55-day exponential moving average has acted as a strong area of support, a dynamic support and resistance. Actually, if I could zoom this further back, you'd see multiple times where prices retraced back to this area between these two moving averages and moved higher. And even more recently, we saw price retest at 105.50 level, and again, the area between the 21 and 55-day exponential moving average, and immediately get rejected. But now we're seeing price managing to stay above that 21-day EMA for quite a few days. Yes, momentum has somewhat declined, but it's still staying above that. But the next few days is going to be critical as to what the US dollar is, as to how it's going to act. If it stays above the 21-day exponential moving average, we could see, I would view this as consolidation before another move higher. But if it breaks below it today, we could see a breakdown. And just taking a look at the US dollar here on my other monitor, it has moved a little bit lower on the back of this CPI print, however, already bouncing a little bit higher and managing to stay above its 21-day exponential moving average. So there is a bit of a wick on the last candle. So dollar maintaining some strength, but losing some momentum over the last few days. And let's see if this results in a change of structure or just another continuation, or maybe a shift from bearish to more neutral. Okay, taking a look at gold. And our gold, after being overbought for a couple of months, really, very difficult to find buying opportunities in gold with these very limited pullbacks. In retrospect, yeah, it's easy to say, oh, we should have bought over here, bought over there. But at the time, I was looking at long opportunities for gold, and I found it very difficult to justify it when prices overbought for so long and just didn't pull back far enough for me. But now we are seeing a bit more of a pullback. We saw price breaking above 177. And then again, reaching an overbought condition, momentum declining, and eventually price breaking below 177 again, off the back of the recent dollar strength. And in the area between the 21 and 55-day exponential moving average. Yesterday, we saw a small bounce higher from the 55-day EMA. But overall, this is the area where I'd start to be looking at potential long opportunities for gold. I still believe gold will remain elevated for the next few months. The only tricky part is finding that buying opportunity. And now that we've had a nice pullback with gold, we could be in store for a short-term buying opportunity back to 177 or potentially even higher. Major resistance on the weekly time frame does sit at 182 and 192, however. All right, moving on to oil. So looking at light crude oil futures. So again, last few weeks I spoke about this range between 81 and 70, and once again, price is respecting this range after this downtrend price has been pretty much locked in this range for the last 3-4 months almost. And it is approaching that 81, 82 area of resistance. And this would provide an ideal risk to reward bearish entry point for a revisit back to 72, which it did touch early last week, or I think a couple of weeks ago on the Friday. So price respecting the range, when you look at energy companies that have a high exposure to oil and have a high correlation with oil prices, the fact that it's so tightly range bound means that the best way to gain exposure to energy is short-term bearish or short-term bullish trades when oil is at support or resistance. So when oil is at resistance, you're looking for a short-term bearish setup. You don't really want to be in this trade for longer than 2 weeks, if even. And then when oil is at support in 72, that will provide an ideal risk to reward bullish entry point, again, for a very short-term trade. On the demand side, well, of oil, I would say it's fairly balanced between supply and demand. On the one hand, we have Chinese reopening, naturally will lead to higher demand in oil and higher prices. But on the other hand, we have recessionary fears that tends to decline oil prices as well. Overall, the structure is still quite bearish, lack of upside momentum. And if we do see a breakdown eventually, we have major support at 61, as you can see on the weekly time frame. Okay. Taking a look at sector rotation, we have 5 sectors in the improving and leading category, and we have 6 sectors in the lagging and weakening category. Sorry, I should say it's 4 and 7. There was some late rotation here for utilities. So 4 in the improving and leading, and 7 in the lagging and weakening. I apologize for that mistake. Interestingly, biggest rotation comes to utilities. Utilities was in the improving category and looked like it was rotating into the lagging category, especially towards the end of the year, where we saw in December a bit of a pullback in equities and a rotation to defense. And then January started in a very risk-on tone, and that's a natural rotation out of defensives, including utilities, which is now back in the lagging category, as well as staples and healthcare heading into the lagging category as well. So defenses, even though Feb has seen a pullback, the fact that we aren't seeing rotation back into defensive sectors does indicate that the pullback is more due to profit taking, as opposed to a rotation into a more risk-averse sector. So I would view that as all in all a very positive thing for equities, that investors are not spooked about the recent rally and they are looking for another leg higher. The fact that we aren't seeing rotation into defenses. Energy is starting to show a bit of a pickup here in momentum, but I wouldn't read too much into that. It was underperforming quite a bit over the last few weeks, and the fact that equities pulled back meant that energy naturally will see an improvement in momentum. But we have communications on the cusp of joining this leading category. We also have real estate looking strong until last week, where we're seeing a bit of a dip in relative strength momentum. And we also have discretionary strong rotation from the lagging into the improving category. I have my doubts about discretionary, as many of you may know, highly dependent on consumer spending. So with high interest rates means less consumer spending, but so far the sector's been doing quite well, also thanks to pretty decent earnings season from the sector. Technology showing some more life lately, and looking like it may also reach that leading category. And with technologies in the leading category, what you tend to see are the major equity indices move higher due to the fact that technology has such a high weighting within those the major indices. Okay, so moving on to some subsectors of interest, we have KWEB, so not a stranger here, a name that we've looked at for quite some time, and pretty much a similar setup that we saw last week. Price hasn't moved all that much. Last week, price was at around 32. It's still at 32, and despite the pullback last week, price is still managing to stay above a key area of resistance at 32, which is still good from a risk to reward perspective for a move higher, but it has definitely seen a reduction in momentum. But bullish structure on the daily time frame remains intact, and my overall target price here at 440 is still on the cards in my opinion, and right now would still be a decent time to get into KWEB due to the fact that the risk to reward is very attractive with price sitting at support. Moving on to biotech, IBB. So biotech, we looked at 138 as a main resistance level of focus. Yes, 134 was a major resistance level on the weekly time frame that we were initially looking at a few weeks back, but we saw price actually manage to break above that. And it really hasn't affected price action too much in the last few weeks, but 138 is the more recent and the more key area of support to be focusing on. And what we've seen here is some bearish price action. I've highlighted multiple times now to be able to enter the trade at 138, ideal risk to reward. And what we could see here is a revisit to 138, once again providing an ideal risk to reward bearish opportunity should we see bearish price action there. If price breaks above and closes above 138, that would invalidate this thesis, and you get to get out of the trade for very, very limited loss. So again, if you did miss out on this trade, wait for retest. And the best strategy for this would ideally be a credit spread that would take advantage of the neutral to bearish price action, as opposed to a debit spread, which you would have to see a large move down for it to be profitable. But biotech still neutral to bearish in my opinion. And the fact that we are seeing such strong rotation out of healthcare, that's also going to have a negative impact on this subsector. XHB, which is the home builder ETF, a new idea for today. We've seen a bit of a change in structure. So price has respected a few levels here over the last few years. $80, 70, 60, and 50. Around those, roughly those price levels have been the pivot levels here over the long time frame of a weekly chart here. And what we're seeing here is capitulation, higher low, strong move higher. And the big test was, could price break above 70 on the daily time frame? It did. And then there was a pullback from overbought condition, which makes sense, back to its 21-day exponential moving average, back to this previous swing level, this area that's provided more recent resistance, and classic bounce moving higher with a pickup in momentum. Ideally, very good risk to reward, bullish entry point for revisit to 72, and potentially even higher. Weekly time frame indicates prices now at the range of between 70 and 80. So 80 would be the longer term upside target here for XHB. Another new idea is DRIV, which is the autonomous and electric vehicle ETF, and very, very similar price action where we saw a strong rally all the way to 25, overbought, and we saw momentum pulling back as price pulled back, retraced lower back to previous area of resistance between 23 and 23.50. Oh, sorry, not sure what's happening here. There we go. So between 23 and 23.50, and classic bounce higher and ideal risk to reward bullish entry point for a move back to 25. Now, if price breaks above 25, which has been a major area of resistance, we have 29 on the cards, which is the next key area of resistance here for DRIV. But good risk to reward bullish entry point currently. Okay, taking a look here at NVIDIA. So NVIDIA, a name that we've talked about for short-term setups as well as long-term setups. Short-term setups have been difficult due to the fact that price has been overbought for quite some time. So we are seeing limited pullbacks, and now price did pull back to the 210, 211 level, and actually already is bouncing higher there. So good short-term entry point, but for the longer term, NVIDIA has great fundamentals. So I do advise looking at, if you are looking for a semiconductor pick, I think NVIDIA would be the best in class for semiconductors. Its fundamentals are great, and future business prospects overall. Yeah, I think there's just a lot of optimism with NVIDIA. They seem to be diversified across a few key thematic verticals, which does help, the optimism. It does fuel for longer term value here. So I think for NVIDIA, now's probably the time to look to be getting in, especially with price breaking a bearish structure on the weekly time frame, forming capitulation and breaking out of that 190 area. Okay, another idea that we've looked at in the past is General Motors. So last week, I was looking at General Motors due to the fact that we saw multiple rejections of 42. Price is once again there, set to open a little bit higher. And despite it acting as resistance, we didn't quite see a reversal. We're seeing neutral price action. We did see a rejection, a very strong rejection of 43 on Thursday, But again, it hasn't resulted in bearish price action and a reversal. It's just resulted again another retest and very neutral, choppy price action. So if we see consecutive closes above 42, I would probably look to close this trade. Again, fairly limited loss. It was a good risk to reward bearish entry point at that time. Didn't quite work out for us, and that's completely fine. This is you're always going to get winning and losing trades, and the fact what's more important is that you get in at a good risk to reward. Okay, moving on to JP Morgan. So JP Morgan continuing to grind higher. This was a bullish play with the pullback back to the area between the 21 and 55-day exponential moving average, another bounce higher. JP Morgan does have very good relative momentum and relative strength against its peers, which is why I like this name. Compared to the other major banks, the performance for JP Morgan has been quite impressive over the last few months. So I do think there's another move higher here on the cards, but limited upside with 146, 147, the upside targets before running into major resistance. But momentum isn't like what it used to be a couple of months back. So upside is fairly limited, but we're still in this trade and no reason to really close it just yet, slowly approaching that target price. Okay, a new idea here for today is IBM. IBM, legacy technology company, and it is a company with, I wouldn't say bad fundamentals, but somewhat declining fundamentals, continuously losing market share. It's, the fundamentals, and there's nothing exciting about them for that longer term optimism. And if you look at the weekly time frame, the last couple of years, actually, I should have zoomed out a little bit further here, but price has been stuck between this 150 level and 110 area or so, roughly. And once again, more recently, we've seen price retest at 150 level on the daily time frame, fail. It was a little bit overbought, and we saw a strong move lower, followed by a retracement higher, lower low. From there, followed by a strong move lower, a lower high, followed by a lower low. And now price has been consolidating. Yes, it has found support at around 133, and it's retesting a previous support level, the previous swing level, at around 138 or so. But risk to reward here for me does favor the downside. It just doesn't have the relative performance against the rest of the market. And I'd be looking at any clues of bearish price action either today or tomorrow for a bearish entry point or revisit back to 133 and potentially even another leg lower, with the next key area at around 125 or so. But if you look at it from a bit longer term perspective, it is quite tempting to see to play for a revisit back to the 110s, 120s for IBM, considering the fact that it has for the last few years been in this big range. And finally, we have Lennar, which is part of the home builder subsector. And we've seen some very bullish price action. So overall, strong bullish trend, 21 exponential moving average acting as that dynamic support. More recently, though, we saw price attempt to reach 110, fail, pull back, and also recover from an overbought condition. And now we're seeing a classic pullback to dynamic support and a bounce higher with strong momentum. This would indicate a move back to 110 is on the cards for the short term and potentially a breakout opportunity, forming a new higher high here for home builders. So a good time to get into this trade now, in my opinion. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I'll see you next week.